So very good morning to everybody, and thank you Aditya for the nice and sweet introduction. So since I'm the first off the block and to be speaking the first, so I'll try to kind of go through relevant slides. The topic that I'm kind of taking up today is to do with the business models and partnerships in the wealth management industry. Though you will see a little bit of more of the UHNI flavor in terms of what I'm going to be talking to you about, but I'll try to also quickly touch upon the trends generically that we are seeing across. So, to go to the first slide, I think, to start with, I thought that, instead of sounding very theoretical, I said, let me straight come to the point in terms of what are the trends that we're really seeing. And this is probably more relevant for the HNI and the UHNI segment of the wealth management industry. So the three things that I see here is, and the kind of the trend that we see is the fact that investing in new startups, unlisted companies is really becoming a flavor of the day. And this has been there for the past 12 to 18 months. There have been really high profile investments that you've seen right from, and this is public information, right from the Ratan Tatas to the Nandan Nilekanis to the Mohandas Pais and Narayan Murthys and so many such kind of visionaries who have really taken up to small ticket size investments. And for the size of business that they've created, looking at these kind of businesses is something kind of a trend that we are seeing not only in that segment but across most of the UHNIs today. And these are more to do with acquiring stakes. Now it could be a financial investment or it could be a strategic investment. We are seeing a combination of both. And that's something with or without the help of wealth managers is a trend that we are seeing today. So there's a lot of investment bankers, boutique firms which have been coming up over the years. I'll not getting into naming, but there are a few of them who have really created a niche for themselves in specific sectors like information technology, biotech, sciences, etc. So they are really very active in this space. And there are many professionals who are also there who have left their respective industry and have taken up this as a career because they all are probably in the marketing space of pharma companies, for example. And pharma as a segment in India is really really growing. So we are seeing a lot of them who have really looked at managing global sales in pharma companies, individuals, professionals who have actually set up their own firms and assisting these families to actually look at specific opportunities, both startups, unlisted companies. In fact, there are some who are even providing advice on acquiring significant stakes in listed companies as far as the pharma space is concerned. So we are seeing a lot of activity there. E-com is one more vertical that is really seeing a lot of interest. And again, here there are a lot of technology, domain expertise oriented professionals situated across the globe who have also taken up this as a career in terms of identifying the right kind of bets. In fact, I know of one of them who's actually started up his own firm who assists families in terms of doing diligence. In terms of, because, in one day he was saying that there are about 22 deals, new deals that he sees across the country. So that actually shows you, not only the opportunity in terms of many people wanting to set up, ventures as far as pharma, biotech, technology, and the e-com space. But on the other side, there are also professionals and experts who have got the domain expertise, who are actually going on their own and trying to assist families. The second, of course, So the only change to the heading that I would say that the wealthier are looking at to take more risks, but with a caveat that they are looking at value as well. So risks is one part of the story, but eventually we are also seeing that deals are not getting closed to the extent what it used to be, say, 18 months to 24 months back. I think lately over the last 6 to 12 months, valuations have become very, very critical. So at a particular value, investments are looking good, and there is a lot of activity that we are seeing in this space. The second, of course, is real estate. Real estate has not been doing very well for the last 24 months, but specifically in the lease rental discounting space, which is your commercial real estate. And again, this is historically, if you've seen at the commercial real estate space in India, it has been driven by MNCs. So to a large extent, they have been absent for the last decade or so. But now there seems to be some bit of activity which is started, though it is very, very initial days. But there are some value deals which are still going on, which investors have been looking at very, very actively. And the main reason for that is the rentals still look good. So it used to be about 10% at one stage. Now it is about 8.5 to 9% in terms of the commercial, space. But this is a trend that we are seeing. There is a lot of commercial real estate demand per se, from the investors. The third is, of course, offshore, and I think that is to do with the amount of depreciation that we've consistently seen in terms of the INR. Now, it is not only in case of INR, it is also about most of the currencies vis-a-vis the US dollar. So, I think this is one opportunity where a lot of kids from these families are actually settling outside, for education and then taking up employment as well, or looking at business ventures. So I think there is a fair amount of interest in creating a kitty, whether it is towards schooling and education and everything. But more important, they have also started looking at diversification. Though the international investment climate is not the best at this point of time, but there is definitely interest. For example, we are looking at Manhattan, commercial real estate, and there is, a set of guys who are very, very, kind of specialists as far as Manhattan space goes. And there are some 192,000 offices in Manhattan. And that's a good space where if you can get good corporate deals, you can make anywhere between 5 to 6% in USD. And of course, for an Indian investor, you have the depreciation also to add. And if there is a capital appreciation, that is a bonus. But I think, broadly, US as a destination, as far as real estate goes, London has always been there in terms of real estate, as a destination. Singapore has become also an area through which people are trying to invest globally. So there are some destinations where, there is interest. So these are the three areas I just wanted to highlight just before getting into our, what we are here to discuss. I thought it just to kind of create interest and keep you awake, at least for the first slide. Okay, so from a business model point of view, I'm sure that everyone knows as to what opportunities are there, etc., etc. We will take you through the generic evolution of this landscape. But before getting into that, I thought I would also want to touch upon one space which I think has not been looked at by the Indian wealth management industry, which is women. I think that is a theme that most of the people have been missing today. In the US, in fact, it used to be about $8 trillion, which is expected to go, roughly to about 20 trillion actually. 8 trillion is the value of the assets being controlled directly or indirectly by, women. And I think that is a segment which I think the Indian private space has actually kind of not looked at. And in fact, I was looking at, across our own institution in terms of whether it is branch banking, retail, as well as our own wealth management, in terms of the spectrum. And in terms of the number of women clients that have got added. And I've seen this actually trend within our institution as well, and I'm sure it would be the case with other banks and other advisors. is that there are a lot of these professionals, self-employed, business magnates. Now you've got a lot of names, both domestic as well as international. I think that's a space to watch out for the wealth management industry from a trend point of view in terms of the opportunity being there, and there is a lot of inheritance also which will happen due to what they have created in terms of. So it's very, very important to kind of get closer to them so that you're able to kind of manage the legacy going forward. Sorry, I think I missed to put on the previous slide before that. Anyway, this talks about how the whole industry is really kind of broken up. So obviously there is a mass market which is there. Then you have the mass affluent and the super HNIs. So let me come from the top of the segment as far as the overall kind of market goes. So to start with the UHNIs, obviously, these are the billionaires and the self-made as well as, the inherited wealth. And this has been there. I think this whole story has really evolved over the last 2.5 decades or so. India has really sprung up in this space for sure. And from a business standpoint, if you're looking at a model to really deal with this particular segment of the industry, they are very sophisticated because they themselves are business people, most of them, and to that extent they are really understand the space. So the profitability, if I have to give you some kind of an estimate in terms of how you can look at the retention per 100 rupees of assets that you manage in this space is anywhere between, right from 35 basis points to about 1%. That is the kind of range that we are looking at. And that is, again, when you're looking at, the median, you probably will end up being at about 50 to 55 basis points as far as, this set of, investors are concerned. And again, there are various models which I will obviously also touch upon, but people have adopted a banking plus wealth management as kind of one way of looking at catering to this segment where you have most of the banks, and the other end of the spectrum is single family offices or individuals who kind of really drive this segment. So from a profitability point of view, obviously it is the lowest. If I come to the next down in the spectrum is the mass affluent, and I think this is where the maximum opportunity looks like today. Not that the UHNI doesn't have the opportunity, yes it does have, but from a profitability point of view, where we were talking about a 35 to 100 bips retention in terms of the assets generically under management, or under kind of advice or under any relationship, we are looking at here at a retention of anywhere between 50 to 150 basis points. So this segment, of course, is the most growing segment as far as India goes, and also there are a lot of opportunities to tap into. I think technology, we would also cover that in one of the slides, is something which is going to be very, very critical in this segment. But at the same time, it's worth looking at it because it is profitable. The last one is, of course, the mass segment, which obviously is on volumes as far as assets goes and as far as the number of people on the street in terms of management. But at the same time, it is best marginally profitable compared to the other two. So if I were to just segment this market in terms of who are the players and what is it really that we are looking at in terms of the services. So the banks and the NBFCs, stroke the brokerage firms, are seen to be very high up in terms of product access as well as distribution reach. And again, there are parts of it which are perception, parts of it which are reality, parts of it which are opportunities, when we look at it. But if I were to just, kind of segment the whole market, the banks and the NBFCs are there, where they are perceived to be, really high up in terms of product access as well as the reach that they have. And when you come down on the right hand side, between the NBFCs and independent financial advisors, the thing is of high flexibility. So they basically are pretty much there in terms of, whatever you need is something that they can deliver, is somewhere the perception. And the reality could be different depending upon whom you're dealing with, but that's the generic perception and reality kind of story. The bottom is, of course, as I mentioned earlier, the individuals, the private family office and the independent financial advisors who are really now springing up in terms of trying to be as personal as possible, etc., etc. So this segment is known to be able to customize, as per what the family requires. And again, this is a perception. It might be reality, it might not be. There are people who have been successful in doing that. There are people who have faltered. But that's where it lies in terms of this space. And of course, if you're talking about the banks again, when you go back, that's an institutional mindset. Again, the private family office to that extent also will be a little institutional in the way they look at stuff. So that's the broad kind of idea if I have to give you from a segment point of view. In terms of landscape, how is it really changed? I think we've started, when we looked at the whole segment in terms of how you have to model your business to approach, this whole segment, the whole set of segments that I talked about in the earlier slide. I think it started out with being transactional. And, the one thing which I can tell you, which is very common across all these that I've talked about here, is relationship. I think relationship still governs, stickiness, so to say. I think if you were to ask any client for that matter, the reaction which comes from any client, irrespective of whichever genre you're talking about, is the fact that my relationship manager is this, is that, is whatever. So what I'm talking about is broadly the evolution of the value-added services that we've talked about. But again, I'm not trying to take away anything from the relationship. So I wasn't able to capture that because that's a very softer part of the story. But that remains as an underlying theme across any segment that you talk about. And this more in the mass affluent, the higher end and the UHNI, of course. The lower end and the mass affluent, the lower end and the mass market may not be to that extent. But the underlying principle remains in terms of relationship as to how the relationship person is, proactive, how is able to kind of come back to you in terms of circle back in terms of anything and everything that is being demanded out of him. All that remains. So relationship, and this is exactly similar to what the European model is. So India per se is a little bit more towards the European model than the US model as far as that goes. I think Indians by culture have this relationship, a softer aspect which still continues is the relationship as far as the advisor goes. So that is something which remains very, very critical. But the way it is really evolved is that we've started with a very transactional thing where, people try out things first as to your capability of delivering things. And this could be simple mutual fund distribution to anything, in terms of PMS strategies or whatever. It is evolved through broking in terms of equity ideas coming in and other, ideas being referred to something, where I think advisory is something which is really picked up over the last 10 years or so, where, the client says, okay, out of my 100 rupees, would you want to really take 20 rupees of that or 30 rupees of that and give me an asset allocation and try to do some stuff for me where I will look at you at a portfolio level in terms of return and not get into line by line return. So I think that's evolved over the last 10 years or so. So advice, the importance of advice is something which has come in, I would say over the last, 10 years or so. And obviously in that, investors have now, and as well as on the other side, all the players have shifted to an open architecture. For example, our institution used to be completely only Kotak, whenever we used to do earlier, 10 years back. But not that I've been there with Kotak for 10 years, so I've changed anything. But I think the overall landscape is changed to an extent where people want advice in terms of making money, but at the same time, are you also getting me the best guys, across? Are you able to get me the best guys? I think that open architecture is, irrespective of whether he's coming from your institution or from somewhere else, is something that is become very important now. Portfolio discipline is very, very important. Earlier, when I remember 10 years back, people used to just shift away from one asset class to the other, depending upon what the flavor was. I think now, with increasingly professionals and advisors coming into the fray, I think the investor community generically have understood that needs to be some discipline in the way you invest things, and they would want to have that monitored as well from a risk point of view. Of course, the family office is something which caught on in the last 5 to 6 years or so, and again here, there is a lot of European, so to say, inspiration being drawn in the way the family office kind of really has evolved, and of course it has got everything in terms of reporting across. So when I said in terms of advisory, it could be 20 rupees or 30 rupees out of 100, but family office is something where you get the entire visibility of the entire 100 rupees, and you need to opine on the entire 100 as to how it should be looked at. And from that point of view, obviously you have a lot of reporting to do, analysis to do, attribution to do, and succession planning is something which also has come in. Estate duty is something that has been talked about. The Indira Gandhi days are to return. Now this is something that has been talked about for a long while now, and so towards that, I think increasingly clients are wanting some kind of an inheritance planning and trusts to be set up, and all of that. The other thing is bookkeeping and asset register in terms of whatever the assets that they have. Concierge services is something, I can tell you an example of a client who said that I want to take off from a naval aircraft, in a fighter jet. And there is this firm who offers concierge, and we came across because he was doing it for one of our clients, and we did some diligence and we found him to be very good. And he actually got Pentagon's approval in about 48 hours, and the client did that thing, out of the US Second Fleet. And he had this experience, so these are the concierge. So I'm just saying, just to give you a flavor, these are the things that now I think increasingly clients want, in terms of experience. So the experience is not about a transaction, is not about an advice in terms of what I have with you. It is going beyond that, So I think that's how it is evolving. And the latest is, of course, this digital craze. I think with the e-coms coming in and the way that you're doing, you're buying your grocery today, which probably 5 years back you never used to even think about. I think everything is gone digital, and I think the expectation is also that as much as possible, clients actually wake up to check what is happening. So if there is a touch point there, I think we are going to that stage where that has become a kind of from a differentiation point of view, a digital capability. When you're dealing with clients, what is a digital capability? Which are the areas that you can really innovate? So innovation is something which is now coming into this space as well. And so from a differentiation point of view, the way this is really evolved is that brand has become very, very important. So brand positioning as to if you are a particular person or an institution or a firm, what is your value? What is your brand? What does your brand talk about? That positioning of that brand, what is it that you're good at, is something which is really coming in terms of course, the digital is very important, and the value-added services, as I said, is very, very important. So new business models, as I said, goes across technology. Automated advisory is something that is being really looked at. Speed of information is something which is becoming a differentiation. For example, people were asking that, with the way, for example, in terms of the debt yields, in the fixed income yields. So there is this increasing thing that there is a debate on which is interest rate going down or it will remain the same. So people want advice and people want to know what are you doing about it. Now for this, the expectation is that not only are you, in terms of the timing of the, these kind of calls which are very important, but the follow through in terms of monitoring and telling them, okay, this is what we've done and this is how it has really resulted. So can there be a technology kind of an interface, because you obviously cannot be talking at the same time to so many people. So is there a way to put out that information? Is there a way to share? Is there a way to interact in a particular manner? So I think WhatsApps, for example, though we all of us use it, but it has also now become a way to really communicate with the client on a, because broadcast is something which is being increasingly used by various advisors to reach out to the clients real time, because that is something which, people have feedback also coming in quickly and then you can interact. So, I mean, I'm just talking about a very basic stuff here, but there is a lot in terms of technology that, there's a lot of work going on in that space. So speed, as I said. And partnerships, I think within industry and outside. Within industry, of course, you have, so for example, there is a lot of investors who really trust chartered accountants, as their only kind of source of providing advice or managing assets or anything. So I think that is a very important segment from a business model point of view, which people have started looking at in terms of, creating those partnerships with them. Legal firms, of course, I think with the kind of litigation that we are seeing, which is, I think, quadrupled over the last 10 years, the kind of business that the law firms are doing with various sets of businesses as well as individuals, that segment has really become a very important, way to partner, to reach out to clients. Of course, the boutique investment banks, as I suggested, because a lot of startups which are being, helped in terms of raising money. So the boutique investment banks are also people with whom, we are increasingly seeing, partnerships going. And of course, there's a lot of Mercedeses and Audis and BMWs and Porsches being bought in India as such. So cars, whether it is a mass affluent or whether it is a UHNI segment, cars are something which have been increasingly seen, and car dealers have been increasingly seeing as partners in terms of introductions. So that's a business model that many of the people have actually taken up to. And of course, real estate and event organizers, etc. Curated service providers, as the one I just said, is someone that also can put you on, or give introductions to the right set of people. And of course, there are angel networks which are on, because as the startup space is increasing, there's a lot of activity which is there on the angel space. So this is also a good forum to kind of forge relationships. So I think just to sum it up, it's probably not what's fueling growth, that's not the right heading. But I think, across business families, the young inheritors of wealth seem to be kind of emerging in the non-metros. I think non-metros as a segment is really now coming into vogue. In fact, there is one individual in Aurangabad who actually is just about 28 years old, and he started a firm in a particular apparel segment, and this he did about 3 years back. He sold the business after 3 years. So when he was 25, he started this business. 28, he sells his business. He gets about 121 crores, and in a city like Nasik, just to give you a flavor. And he's a self-made person. Got funding from a few set of high net worth individuals at one point of time, but now has got about 121 crores. So there is a lot of such young self-made kind of wealth which is there. But at the same time, these segments have got a lot of young inheritors as well, because there's a lot of business which has been there for quite a while, like 2 decades, 3 decades, more than that. And these have been flourishing businesses where probably the older generation, the first or second generation, have not been looking at wealth management as a very serious kind of business. But I think the young set of inheritors have actually started, because they are educated. Most of them go abroad, have their education, come back, and they are running their businesses. So these people have actually taken up to the services of most of the advisors and the wealth managers. So I think that's a very interesting thing that one should be looking at, the non-metros and the young inheritors of wealth. At the same time, we should not ignore the young, self-made guys as well. Startups, as I said, the new age entrepreneurs are actually trying to create value much faster. And we were doing this exercise across Infosys and some of these big companies, and with their founder promoters. And when we actually were interacting with them, what came out in those discussions is that what took them 12 years, 15 years to create value. I think there are these set of entrepreneurs, whether it is the biotech space or whether we are looking at the e-com space, they are creating it much faster. And I think that is also to do with the global liquidity which is there. There's a lot of money chasing the right business, business which has got merit. So people in India have this tendency to kind of move on quickly, just to sell, take their money in and then again, get into risk. I think this is unlike the West, where they keep on investing and they, so we've got a lot of these, entrepreneurs who keep doing that. And in fact, just as another example, a technology firm. This is a listed company. I would not get into names here, but this is a listed company who's been into this software outsourcing business for a long while now. And he actually said that there is one thing which is lacking in the biotech space, is that I can use my IT markers to create biomarkers. So basically this firm is a startup of a promoter who was into IT business, who is not really succeeded, but today with technology being used in various segments, he's actually used his IT into creating biomarkers, where he's actually gone to Antarctica, where the entire population of Antarctica, he's created biomarkers in terms of each set of individuals in that particular country. And now he's obviously replicating that in India, and he's one of the most sought after business or promoter in terms of right from the sequoias to everybody wants to take a exposure, but he doesn't. He's not really interested to give any stakes to anybody. But he's someone who's actually done 3 rounds of funding. He's taken out money from his initial startup that he's done. He's already created a 225 crore kitty in terms of all the round of funding that he's done, and now he's looking at his business, which is valued today at about 1,200 crores. So obviously his stake still remains at about 43%. So that is the kind of value that these people are creating in technology. So I think that's some segment. Again, this is a non-metro I'm talking about. So these are segments that really one should look at, and channel partners, of course, in the non-metros are kind of very important. But just to sum it up, I think the relationship aspect is something that we should not, as I said, ignore. I think that remains the foundation of whatever we've talked about. But increasingly, we are really seeing that whether it is advice or whether it is any other service, I think the speed of delivery is something which is really becoming the big differentiation. So apart from the positioning that you do across in terms of the breadth and depth, I think the breadth and depth are seriously required in terms of whatever you're doing, and the brand value gets created out of that. But at the same time, it's really important today in terms of the speed of delivery of all of these that we are talking about. It cannot be something that you talk about it and then when it comes to delivery, you're just not there. So I think the speed is becoming very important, and that's why probably the technology is also becoming a very important, is playing a very important role today. So that's it, and if there are any questions, I'll be very happy to take.
Rajesh.
Hi, how are you?
Just taking on a lighter note, I think your advice of get close to women should be taken with a pinch of salt compared to what your competitors facing an issue on that front. You just want to be more careful advising that. Yeah, coming to the question. So what is your view now on currency? Because at one stage, obviously, we've gone through a significant devaluation, but now with a lot of FDI inflows and even FI inflows picking up, what should be the call now to be taken on the currency front for HNIs?
No, I think it's not anymore a INR story or anything. I mean, INR on its own, India on its own is shining. I mean, there's no question about that. The kind of opportunity that we have here is unparalleled, and I think that's something that global investors really recognize that. But I think the problem is not to do with INR, but to do with the fact how the globe is today, and the fact that USD remains the currency of destination. So everything vis-a-vis the USD, if you see, obviously, so it's again a very relative question. Whether are you asking a question vis-a-vis the USD or any other currencies? Because vis-a-vis the USD, it still seems to be that the US is in a much better wicket compared to any of the other, the developed 8, the G8, so to say.
Even post-Trump?
I think Trump, we need to wait and watch. But, it could be rhetoric. I mean, he might not be what he is as of today. He might be a very different person, so we don't know. But yeah, increasingly that is one risk which is there in terms of whatever. It's a risk or opportunity. People say it's an opportunity also. So it's the way you look at it. But increasingly the chances of he coming back is there. But given that even whether he comes or doesn't come, relative to the world, US seems to be in a very solid footing today. So we still believe that irrespective of where we are and where we can go, I think INR will be subject to pressure. And 3 to 4% depreciation, as we all say, kahin nahi gaya.
So, hi, this is Vidhu Shekhar from CFA Institute.
Hi.
I wanted to understand how you monitor your advisors. How do you identify poor advice and correct, or if something's going wrong, change the advisor? What are the processes that you have?
Yeah, so I think when I kind of took over this 10 years back, I think the one thing I did in the first 2 years was within the team, when we are talking about investments, I have split the team into 2 parts. So one is someone the set of individuals, and these are all professionals who have been doing this for the last 20 years or so, 15 years or so, in various asset classes. And they are responsible for interacting with the capital markets as well as the counterparties. So that is what I call as the product group. The product group will only look at ideas. And obviously, it is their responsibility then to monitor it, in terms of each of the advice that I have given, and what is really happening is something that we monitor on a monthly basis. But at the same time, what I also realized in the first couple of years is that advice once given is not followed through for clients. It becomes very important that if I'm managing your portfolio and I've given you a particular advice, as an institution I've given you a particular advice, what am I doing at the time when there has to be a change, in what I already have with you. So I think I have set up a group of professionals who are also called the portfolio advisors. So they are client facing. So this is not the IC concept as a city or any of the other which we never believed that strategy will work because they manage P&L, so there is a conflict there. But we have a group of portfolio advisors who will only look at client portfolios and opine onto the timing in terms of taking actions.
The question is, how do you, if you find that you have processes in place, you find some people are performing better than the other, what's your monitoring mechanisms and incentives or punishments or whatever? Like, how do you continue to improve the quality of the advice that goes out from you?
See, again, the advice remains the same, whether it is a 5 crore client or our biggest one is about 3,200 crores. 5 crores to 3,200 crores. That's the kind of clients that we have. So the advice which goes or gets executed, so advice which goes remains same, consistent. The color of advice can't change. I mean, for one guy, equity will look good and the other guy, that will not look good. That can't happen. It's the risk profile which will determine whether he does it or he doesn't do it. But from our point of view, any advice that is being given, we have to also track, and these are all investments across the asset classes that I'm talking about. So first is the monitoring of that advice at our level, which is the product group. Secondly, whether the product or whatever that advice being given. So if today, for example, we've said that we've been there in the fixed income for the last 3 years, and we've seen the yields really coming down to 725. So at 725 10-year, does the duration make sense? We believe that it doesn't make as much sense as it used to at one point of time. Now that is the advice which has been given. At the same time, are we executing it? So for that, the portfolio advisor takes over. So it is his responsibility to ensure, that is executed. Now in terms of performance, to go back to your question on performance difference, the performance difference can happen due to time. I mean, there might be some money which comes in earlier, there might be some money which comes in later. So there is a TWIRR which we anyway do, time weighted IRR, which we anyway do. But that will be vis-a-vis the benchmark. So from a benchmark perspective, the relative, differential of the alpha is always monitored, and the incentive is given to the portfolio manager that as much as possible, they should be able to execute that. And execution is about the fact that you are able to convince the client, because we have a non-discretionary, we don't manage discretionary money. So non-discretionary is a capability of the advisors and the relationship manager to be with the client, to be able to get that advice executed. And that's where he gets his performance also, in terms of the incentive that we give.
Hi, this is Ashutosh Dapke. I'm chartered accountant. And as you said, it doesn't make any sense at these yield levels to be into higher duration products. So for a person who is looking at 3 to 5 years of investment into fixed income, which is the better product in mutual funds available today?
From a fixed income point of view? I think fixed income has become a little difficult to opine, because everything is 3 years now, in terms of taxation. The long term kicks in only after 3 years. So anyway, everything is 3 years. You want it or not, whether even if you do the 1 year, it becomes a 3 year. I think that's the tricky part, because in terms of when you said yields, now yields are something which you can predict for the next 6 months. You cannot predict for the next 12 months. So what we really do is we don't really get into tick by tick kind of estimation as to how the yields can. We look at the space, we look at the yield curve, generally where they are. So for example, we liked SDLs just about 6 months back, because it still gave a good kind of a kicker. A tax-free today is 7.35, for example, 6.35 for that matter. So when you're looking at anything in terms of SDLs, you're looking at a good, nice, 50 to 60 basis points. Again, you have to be very clear in terms of what SDLs you're looking at. So the way that we look at constructing portfolios, if it is for long term, is that we will do a lot of HTM products. So where you are invested for 5 years, 10 years, and that's it. These are like FMPs, but in the open-ended platform. So we go with kind of HTM products. Also, credit is something we see a lot of value. So we actually invest in credit. But again, we are blessed because as a bank, we have a 90-member credit team which is available to Uday. So we also kind of consult them in terms of each of these credits. And to that extent, obviously, we are able to do a fair bit of credit also in the portfolio. And of course, you have from time to time, depending upon how the 10-year behaves or the longer end of the curve behaves, if we believe that there is a little bit of a 1 year or a 18-month kind of an opportunity where you can see yields substantially, not 25 bips or so, which is what it is today, because the expectation is the max that you can go is 710. Below that looks to be very difficult today, we might be wrong. But if there is only this kind of money left in the table, we really don't do these trading kind of products, but we will remain in the shorter term, kind of the yield curve.
Okay, so for a retail investor, mainly FMPs is a safe bet.
FMPs, again, you have to look at credit, how much you have credit, how much you have. So it depends. So it is a portfolio approach you have to do. You have to do a combination of short-term credit as well as those long-term, kind of funds.